The fire lasted 9 minutes. The financial damage will last years. Within 60 seconds of opening her insurance claim summary, Neha Kapoor realized she would personally owe $91,300. Not because her claim was denied. Not because she missed a payment. But because of one definition inside her policy that determined which limit applied first. Neha is 52 years old, a financial consultant who advises clients about risk management every single day. She reviews her own insurance annually. She increases limits when recommended. She adds endorsements when her agent suggests additional protection. She believed she was prepared. She believed she was protected. She was wrong. When an electrical surge triggered a fire behind her living room wall, she assumed the damage would be stressful but financially manageable. Flames traveled through wiring and insulation before firefighters extinguished the blaze. Smoke-filled cabinets, settled into ceilings, coated appliances, and seeped into upholstery. From the street the house looked intact. Inside, it was contaminated. Within days, contractors delivered a certified estimate totaling $158,700. Structural repairs. Smoke remediation. Electrical rewiring. Appliance replacement. Furniture restoration. Temporary relocation. It was a 6-figure loss. But Neha believed she carried 6-figure protection. Her homeowner's policy included extended replacement cost and equipment breakdown coverage. She added that endorsement 2 years earlier because it sounded modern and comprehensive. Equipment breakdown protection gave her confidence that electrical failures would not become financial disasters. In the first week after the fire, she approved $26,400 in emergency mitigation services. Industrial fans. Demolition of damaged materials. Smoke treatment. Sealing contaminated spaces. The adjuster described the incident as a covered electrical fire loss. That phrase gave her reassurance. Covered. Electrical. Fire. Loss. For 2 weeks she coordinated contractors, relocated essentials, and reassured clients that insurance would handle the majority of expenses. She focused on logistics instead of fear. Then the official coverage determination letter arrived. The claim was not denied. It was partially approved. Structural fire damage qualified under the dwelling portion of her policy. But the origin of the fire was classified as internal electrical arcing. That single classification triggered an equipment breakdown sublimit of $40,000. Because the initiating cause was categorized as equipment failure rather than an external peril, the specialized sublimit applied before broader dwelling coverage activated. Insurance does not respond to what looks dramatic. It responds to definitions. Of the $158,700 total documented loss, $67,400 qualified under structural fire provisions. Another $40,000 was approved under the equipment breakdown limit. After subtracting her $6,000 deductible, total payout equaled $101,400. On paper, $101,400 sounded substantial. In practice, it left a significant gap. Temporary housing reimbursement was prorated based on the percentage of covered damage, resulting in an additional $18,000 denial. When Neha recalculated everything, her uncovered exposure reached $91,300. She stared at the number in silence. It was not a denial. It was a limitation. She called her agent that evening. Her voice was controlled, but tension was unmistakable. "I thought this was covered," she said. The agent responded carefully. "It is covered, up to the equipment breakdown limit." The sentence was technically correct. The impact was financially devastating. That night Neha opened her policy and searched for the language herself. On page 63 she found the clause, "Loss caused directly or indirectly by electrical arcing shall be subject to the equipment breakdown limit." The clause was not hidden. It was embedded within the endorsement she trusted. The word endorsement implied expanded protection. But inside that endorsement lived a cap controlling the most expensive category of this type of loss. The pivot was not in the fire clause. It was in the definition of cause. Contractors confirmed the initiating event began inside a surge-damaged breaker panel. The fire was real. The smoke was real. The damage was real. But insurance responds to what started the event, not what it became. Neha hired a coverage attorney for $8,200 hoping to challenge the interpretation. Reports were reviewed. Engineering opinions were exchanged. Documentation was analyzed. Months passed. Eventually, the insurer conceded an additional $14,500 tied to disputed structural components. But the sublimit classification remained intact. Even after the adjustment, Neha still faced $76,800 out of pocket. To complete restoration, she liquidated $45,000 from retirement investments she had planned to leave untouched for at least another decade. The remaining balance was financed through a home equity loan at 8.1% interest. Over 10 years, projected interest alone would exceed $27,000. When opportunity cost was considered, the long-term financial impact surpassed $100,000. The fire lasted 9 minutes. The financial consequence will last much longer. The house was repaired. Walls repainted. Wiring replaced. Cabinets refinished. The visible damage disappeared. But something permanent shifted. Neha recalculated her retirement timeline and realized she would likely need to work at least 3 additional years to recover compounded losses. The stress did not come from flames. It came from precision. The contract performed exactly as written. Friends later asked how a standard electrical fire could leave such a large unpaid balance. The answer was sequencing. When a loss originates from internal mechanical or electrical breakdown, many policies apply a specialized sublimit before broader fire coverage activates. That technical distinction can dramatically reduce payout even when total damage exceeds 6 figures. Months later, Neha requested premium comparisons to increase the equipment breakdown limit. The annual difference would have been approximately $1,120 more for substantially higher protection. Compared to $91,300 in uncovered loss, that annual increase felt painfully small. The most unsettling realization was not that the insurer failed. The clause was structured. Enforceable. Clearly disclosed. The expectation gap was hers. She understood coverage amounts. She did not fully understand trigger definitions. Now, each time she resets a breaker switch, there is hesitation. Not from fear of flames, but from awareness of financial vulnerability. Insurance contracts operate with precision. And sometimes precision is the difference between protection and a $91,300 surprise. If this happened in your home tomorrow, would your policy respond the way you expect? This story is fictional, but the insurance mistake is real. For more stories like this, subscribe to Policy Nightmares so you don't miss the next episode or continuation of this story.